Shares of two-wheeler manufacturers Bajaj Auto and TVS Motors fell in early trade after the government slashed export duty drawback rates to 2% from the earlier 5.5%. Both the companies have said they will hike prices in the international market to pass on the additional burden. Kartika Trihan with a detailed report.
At a time when demand is slowing down in domestic markets, two-wheeler makers led by Bajaj Auto have been banking heavily on exports to keep their bottom lines intact. But the government's decision to slash export incentives has come as a rude jolt. Two-wheeler companies say they have no option but to hike prices.
Once we get to grips with all the details in a few days, we will pass on this entire 3.5%, or let me say almost all of it. It has to be from the 1st of November. I don't think 2% and 3% of a rise is a very significant.
But industry analysts feel otherwise. They say a price hike at this point in time may not go down too well, as it will give the Chinese players a clear edge, especially in some markets like Nigeria.
Commercial vehicle makers, it's very easy to adjust the prices. They will raise the FOB value of their exports and accordingly compensate for the drop in the incentives. For two-wheeler makers, that is also possible, but it might happen with a little delay. And from market to market, the dynamics are different.
Exports contribute a big chunk of Indian two-wheeler makers' revenues. For Bajaj, global sales account for 35% of its total revenues. And in case of TVS Motors, it is around 11%. Even commercial vehicle makers like Ashok Leyland will have to swear it out because of their high exposure to global markets. The government may be justified in withdrawing the duty stops, which were doled out as a part of the bailout package, but coming at a time when the industry is struggling to find its feet against the backdrop of slowing domestic demand and high raw material prices, this move could rattle the nerves of the auto industry. Kartika Trihan, ET Now, Mumbai.